Many individuals exhibit common financial behaviors that hinder wealth accumulation. A prevalent pattern involves living strictly within the confines of current income. Impulsive spending is another key characteristic, often leading to unplanned expenditures. Savings are typically only considered after all other expenses and desires are met. This approach results in saving only the residual amount, if any, at the end of a period. Such a cycle makes it challenging to build substantial wealth and achieve financial growth. A crucial financial shift begins when spending is brought under control. This marks the transition from reactive spending to proactive financial management. Systematic investing is then initiated, moving beyond mere savings. Assets are actively constructed, focusing on wealth, accumulation, and growth. This indicates a significant move beyond initial financial struggles or traps. The initial stages of wealth accumulation often involve implementing sound financial practices. Despite diligent efforts, progress can feel incrementally slow and almost imperceptible. This sensation arises because early gains, though real, are often small in absolute terms. The lack of visible, rapid growth can lead to feelings of stagnation or discouragement. It is crucial to recognize that this perceived slowness is a normal phase in long-term financial growth. A common misconception in finance is confusing activity with actual wealth accumulation. Financial activity refers to actions like opening multiple brokerage accounts. It also includes frequently switching between different investment products. These actions are often perceived as productive steps towards financial growth. However, such activity does not inherently lead to wealth accumulation. True wealth accumulation focuses on strategic, long-term growth and value creation. True wealth growth is not primarily driven by constant, intense activity. Instead, it flourishes through a consistent and steady approach over time. The principle of compounding is fundamental to this sustained growth. Compounding allows returns to generate further returns, accelerating wealth accumulation. For compounding to be effective, a stable environment is crucial. This stability permits consistent reinvestment and long-term benefit realization. Compounding is a financial principle where earnings generate further earnings over time. This process typically leads to exponential growth of capital if left undisturbed. However, frequent movement of capital between different investments or strategies disrupts this process. Each such movement effectively resets the compounding cycle. This interruption prevents the realization of exponential growth, hindering long-term returns. Long-term investing yields benefits when assets are held for an extended duration. This strategy allows the principle of compounding to fully mature. Compounding requires sustained periods without disruption to maximize returns. Therefore, patience and commitment are crucial for realizing long-term investment gains. Diversification is an investment strategy designed to protect against market volatility. It involves spreading investments across various assets to reduce risk exposure. However, over-diversification can dilute potential growth opportunities. This can result in merely average investment returns, hindering optimal portfolio performance. A common investment approach involves owning numerous small positions across various assets. However, this strategy often leads to suboptimal or mediocre investment outcome. The core principle suggests that attempting to own everything dilutes focus and returns. Instead, investors should prioritize intentional ownership of high-quality assets. This focused approach aims to maximize returns by concentrating capital on superior investments. Financial independence is significantly accelerated by strategic investment choices. This acceleration occurs when investments are concentrated in strong, resilient businesses. Focusing on productive assets is another key component of this strategy. These assets are characterized by their ability to generate consistent value or output. Investments should also target structures that reliably produce cash flow. Such cash-generating structures provide a steady stream of income, bolstering financial growth. Investing often involves a critical period where patience is severely tested. This phase typically occurs between the 3rd and 7th year of an investment strategy. During this time, many investors experience significant doubt regarding their chosen approach. The primary cause of this doubt is the perception of slow or insufficient returns. Consequently, individuals may feel compelled to abandon their long-term investment strategies. Understanding this patience threshold is crucial for maintaining investment discipline. The compounding discipline test evaluates sustained commitment over time. Exponential growth often appears insignificant during its initial stages. This requires individuals to maintain discipline despite a lack of immediate, visible results. Sustained commitment is crucial for realizing the long-term benefits of compounding. The initial years of investing are crucial for establishing a strong financial foundation. This period is primarily dedicated to building the foundational capital base. A robust capital base is essential for achieving future exponential growth. Strategic investment during this phase maximizes long-term financial potential. Consistent investing over time builds a financial base. This base accumulates through regular contributions and compounding returns. The early years establish the foundation for future growth. In later years, this accumulated base translates into significant financial freedom. The power of compounding becomes evident, yielding substantial results. This phase marks the realization of long-term investment goals. Wealth building is a process characterized by distinct phases of effort and reward. The initial phase demands significant patience and delayed gratification from individuals. During this period, visible results are often minimal despite consistent effort. Subsequently, a later phase emerges where the accumulated efforts yield more apparent and substantial results. After achieving financial protection and stability, the next phase is crucial for wealth growth. This involves strategically expanding the asset engine, your portfolio of income-generating assets. Many investors often hesitate at this stage, missing opportunities for significant expansion. Scaling the asset engine requires a clear strategy to acquire more assets that produce consistent returns. This could include reinvesting profits, diversifying into new asset classes, or increasing existing holdings. Overcoming hesitation and actively scaling assets is key to accelerating long-term financial independence. Scaling requires increasing the percentage of income invested to accelerate wealth accumulation. Automatically reinvesting dividends maximizes returns through compounding growth. Acquiring assets that appreciate in value is crucial for long-term financial expansion. Expanding diverse income streams mitigates risk and enhances overall financial stability. Effective scaling is crucial for business growth and sustainability. It fundamentally relies on leveraging robust financial knowledge. This knowledge enables disciplined decision-making processes. It prevents the need for increased risk-taking in expansion efforts. Furthermore, it helps avoid the accumulation of unsustainable debt. Scaling in finance involves accelerating the growth of a wealth engine. It is not about taking on higher risks in financial actions. Instead, scaling focuses on executing larger financial actions. These actions are characterized by increased discipline and strategic planning. A significant financial transition occurs when investment income begins to grow. Initially, this income covers minor expenses, gradually expanding to fixed expenses. Eventually, investment earnings can cover all lifestyle expenses. This progression reduces reliance on active income, leading to greater financial independence. Consistent cash flow from assets signifies a stable financial foundation. When this cash flow reliably covers living expenses, a significant shift in decision-making occurs. Financial security reduces the influence of fear and choices, promoting more rational decision. This stability enhances an individual's negotiation power in various personal and professional contexts. With reduced financial pressure, awareness of new opportunities sharpens, leading to proactive engagement. Overall, consistent asset-based cash flow fosters autonomy and strategic thinking. The invisible wealth phase marks an advanced stage of financial growth. During this phase, wealth accumulation is not outwardly dramatic or conspicuous. Instead, net worth compounds silently through strategic investments and asset appreciation. Equity in various holdings grows steadily, contributing to overall financial strength. Passive income streams become stable and reliable, providing consistent financial support. This period is characterized by a significant strengthening of overall financial resilience. Anti-fragile wealth represents a state where assets benefit from disorder and volatility. Unlike robust systems that resist shocks, anti-fragile wealth thrives on them. Economic downturns are perceived not as threats, but as strategic buying opportunities. Market volatility, often feared, is leveraged to generate further gains and advantages. In this paradigm, the passage of time becomes a powerful ally, enhancing growth. This approach transforms uncertainty and stress into sources of strength and prosperity. A profound mental upgrade is crucial for navigating financial markets effectively. This mindset minimizes the impact of short-term market noise and urgent headline. Emotional reactions to market cycles lose their influence with a strategic approach. This stability is achieved When a solid financial structure underpins decisions, the ultimate goal shifts from seeking quick, short-term growth. Instead, the focus is on achieving durable and sustained growth over time. This sustained growth leads to a state of true financial freedom. Financial freedom implies stability and control over one's economic future. In this state, life becomes strategic, guided by long-term planning. It moves away from a reactive existence, responding to immediate pressures.